Now let's have a look at depreciation. The specific objectives for this lesson is as follows. We need to explain the meaning of depreciation, provision for depreciation, and book value. We need to explain and distinguish between the methods of depreciation, which include straight line, reducing balance, and revaluation. And then we need to calculate the depreciation using the above methods at the end of the financial period. Now, what is depreciation? Our business bought a vehicle on 1 January 2016 for 100,000 Namibian dollars. But at the end of the financial year, that is 31 December 2016, the value of the same vehicle was 88,000 Namibian dollars. Now you might ask, why is the value of the same vehicle $88,000? Well, because this vehicle depreciated with 12,000 Namibian dollars, which means it's not a brand new vehicle anymore. It's a vehicle that is a year older. So the definition of depreciation is an estimated loss of a non-current asset over a financial period. Now let's move on to provision for depreciation. Now provision for depreciation is the accumulated depreciation amount of a non-current asset for a certain date. Now let's have a look at an example. The depreciation we incurred for 2016 for our motor vehicle was 12,000, and the depreciation for 2017 was also 12,000, and for 2018 the depreciation was again 12,000. Now our provision for depreciation would be equal to 36,000, because 12,000 plus 12,000 plus 12,000 will give you 36,000. Now let's have a look at calculating the book value of a non-current asset. You take the original cost of the vehicle, which is 100,000, less the provision for depreciation, and if you subtract the two, you will get a book value of 64,000 Namibian dollars. Now let's have a look at how we would record this in our balance sheet. On our non-current assets section of the balance sheet, we will have vehicles with a cost price of 100,000, provision for depreciation of 36,000, and a book value of $64,000. Now let's have a look at the different methods of depreciation.